Thank you for joining me on FutureMoneyTrends.com. I'm here with economist Michael Krieger. I'm a big fan of his work. You can see his work at ZeroHedge.com almost on a weekly basis. He graduated from Duke University, worked for Lehman Brothers for a bit from 2000 to 2005. Also with Bernstein, he was in the commodities trading desk analyst. And he currently writes, and his information goes to Zero Hedge First, which it finds itself all over the internet. So anybody who's been researching gold or silver has probably run into his work at some point in time. Michael, thanks for coming on the show today.
Dan, pleasure to be on with you. And I just wanted to mention as well that I had actually seen your YouTube channel before we even got introduced to each other, and I liked it back then before I even knew who you were. So it's funny to just come full circle and be doing this now, but that's great. So thanks for having me.
Thanks very much. Well, sir, I just want to get right into this. A lot of people are wondering why. We see the government shutdown was averted a few months ago, and it was a really big deal. And here the debt ceiling was supposed to be even an even bigger deal, and here we've now breached the debt ceiling, and no one is talking about it. I just want to get your thoughts on what's going to happen with this debt ceiling.
Yeah, I mean, I think the reason that no one's actually talking about it is because everyone assumes that this is just a big political football that's being played out by the two main parties, Democrats and Republicans. And at the end of the day, they'll raise the debt ceiling because nobody wants to be accused of shutting down the government or stopping things a year before a presidential election. So that's why I think that people aren't paying too much attention to it. But, at the end of the day, I think the worst thing that could happen, and people may pay attention to it, is if you get a situation where they end up raising the debt ceiling significantly without any real spending cuts or revenue increases or anything. I think that could actually be a big catalyst, because then people are going to say, oh, wow, look, they're not doing anything over in the United States, and they just raised the debt ceiling by a couple of trillion. At that point, I think it could be a catalyst for the market. But until people sort of see what we get with the debt ceiling raise, which I believe will happen, people are just taking a step back and not thinking about it.
Now, when it comes to QE3 or whatever they're going to repackage it as, do you see that as inevitable?
Oh yeah, I mean they'll have to do something, without question in my mind. I think that the notion that the Fed is going to take a step back, right? And as some people even said, tighten monetary policy when the economy and the economic statistics are rolling over as they are right now. And they're not just rolling over in the United States, they're rolling over in Asia, in China in particular, which is part of what caused the recent scare in commodity prices. So I think the idea that with so much angst out there right now amongst many Americans, that the Federal Reserve would just stand back in the face of declining economic data is preposterous, actually. And if you listen to Bernanke, he always makes it very clear that any change in policy is subject to the economic data and how that's coming in. And whether it's jobless claims or durable goods orders, the data has been coming consistently weak now for a few weeks.
Yeah, it really feels like...
And I've written about this. What I actually think is going on is that the Federal Reserve would like to bluff the market and make the market believe that they are going to stop so that they can get commodity prices to cool off significantly. Because that's been the big pushback to the QE, has been the rising commodity prices. So what they'd really like to do is make the market think that, get commodity prices down, and then they feel like they would have more cover to launch another round of stimulation. Whether that's QE3 or something else, they definitely want to do it, in my opinion.
Now, this head fake that you foresee, as far as with the Fed, do you see this being something as big as, could it be like a Lehman Brothers summer that we have as far as the filling of the market?
You would think it could have been, but here's why I start to question whether we're gonna get that, because you already had a huge scare in the commodity complex, and that was related to, well, in my opinion, there was a lot of manipulation, but let's assume that there wasn't. It was related to fears about China slowing down faster than expected and having a hard landing. But it was also related to QE2 stopping and people sort of front-running that trade. Yet you didn't really see the stock market averages fall by much. I think the S&P 500 may have declined by around 3% from top to bottom, as silver prices went down 30% in a week. Oil prices went down 20% in about a week and a half. But the stock market didn't barely budge. So the whole thing kind of stinks a little bit to me. So I do think there's going to be huge dislocations in the market at some point in the future. I'm just not sure that it's going to be in anticipation of the end of QE2. I think there's going to be some other catalyst.
Do you have any ideas? I mean, you said the debt ceiling could eventually end up being one. Do you have it if they raised it several trillion or a few trillion? Are there any other things as far as the next 3 months, 6 months, 12 months? Are there some things that you're really watching right now?
Yeah. I mean, there are several things, and I'll sort of touch upon three different regions. The first thing that I think the most important event of this year by far in the financial markets and the geopolitical area is have been the overthrows of governments in Tunisia and Egypt, and then how that spread to other areas where things are still ongoing, like Syria, Libya. Obviously, we're at war there, and then the Bahrain uprising, which was put down by the Saudis with our, of course, approval. The reason why I think this is so important is because in the beginning of any monetary inflation, if you look back in history, there's a period where at first everyone seems to think it's working, and you get more benefits than you do negatives. And so everyone thinks, well, this is great, this whole printing money thing. Well, at some point in the future, you start to see the cracks in the system arise. And in this case, as I've called for from the beginning, those cracks would be seen in the commodity complex. And so what really was happening in Egypt and in a lot of these countries was that the price of things was going up so much, you had social instability. And that was the first sign, I believe, of the cracks in the inflationary policy. So what I would expect to continue to happen now is that these countries need to continue to subsidize their people via, cheap food or cheap oil, and that's going to just make commodity prices go up even more. And that'll have more, and you'll have more cracks. So I think you got to continue to watch the Middle East. That's just. I think we have a timeout right now, right there, and we're sort of in the eye of the storm. So I expect more turmoil in that area that'll affect oil prices. And so that's one catalyst. The other one that really people aren't talking about a lot, but is very important, and actually has marked turning points in markets over the past 5 years, is the Chinese currency situation. And what's interesting is if you look back to 2008, the Chinese yuan, when it stopped appreciating, and that was in it was early July 2008, that was also the exact top of the commodity market. Now, I don't think that's going to happen again. But what I'm saying is that the policy related to China's exchange rate has a huge impact on commodity prices and just global flows of capital. So what China decides to do with regard to the exchange rate, I think is important, i.e., are they going to allow a accelerated appreciation from here? Because if they did, that would be one way to battle inflation that they're having, and it would also push commodity prices up and destroy the business models of a lot of American companies that source from Asia and then sell here. So that's one that no one's talking about that I think is very important. And then finally, of course, what's going on in Europe, which I believe that ultimately the euro will break apart. Now, I'm not making a call for like the euro versus any other currency, but I do believe that Greece will ultimately leave. And I think when you hear politicians say stuff like, there's no chance we're ever going to let Greece leave, that means they're going to go. So That would cause, of course, huge amounts of turmoil.
Now, when looking at the silver market, there's a lot of post-traumatic stress out there from 2008. And I know you specifically focus on precious metals and for the last decade plus. What do you see going on with silver? And can you just talk about, maybe let's go 6, 7, 8 weeks back and then 6, 7, 8 weeks forward?
Sure. Okay, so let's go back to what just happened. I mean, I think it was clear that what the authorities have liked to do, if you look closely, and I've been in the markets for a while, and things are increasingly becoming manipulated, in my opinion. They sort of allowed the price, it seems, to get back to that $50 level, that hunt level from 1980. And then through a series of margin increases and flash crashes when nobody was really trading, they got the price to crash, within a week by 30%. And That seems to be the tool of the authorities right now, is to try to manage perceptions, and as you said, this post-traumatic stress caused that, and caused psychology, and caused people to, as I mentioned in my email this time, useful idiots to start spouting. So, of course, right after silver tumbled, everyone starts saying that you never looked at silver before. Oh, $50 Hunt Brother high, it's going to go back to $5, and you start getting all this crazy talk, and people get scared. And they don't go and act, and they don't go and buy when they should be. Now, here's where I think the key thing going forward now is that there's so many reasons why this isn't a repeat of let's say 1980. First of all, back then Volcker did something at the same time, which was raise short-term interest rates into the double digits, and there's no way Bernanke is going to do that. So it wasn't just a vacuum where silver collapsed from 50 to 5, over a 10-year period. I mean, it was accompanied by extraordinarily tight monetary policy, which I think is absolutely never going to happen in this day and age. So we need to understand that. The other thing is that then it was just a couple of players trying to corner the market. This is more of a global movement, and thousands, if not millions, of people around the world really understand what's going on, and the gig is basically up. So there's nothing they can really do, in my opinion, when the physical market is being bought up by, say, millions of people all around the world. And that is what's going on. And here's the other thing. With gold, central banks still have a lot of gold. I mean, we don't know which central banks, but it's out there. So they can always sort of steal it or use it or sell it, whereas with silver, central banks don't have any silver. So there really isn't anything that the authorities can do if you recognize the weakness in the system, which is silver, and you decide to buy it, and others decide to follow. The upside's almost unlimited in the near term. And so I think we're going to chop around for a little bit, but then go much, much higher. And I actually wouldn't be surprised to see over $100 in silver within the next 12 months.